I can, if you don't mind, just before, because we were waiting, the reason we started a little late was because we were waiting for a statement. If you can just bear with me for a second, I will just read this on the record. It's about Russia and Ukraine. So the Secretary General welcomes the exchange of 230 Ukrainian and 248 Russian prisoners of war between Ukraine and the Russian Federation, the largest such exchange since the Russian Federation's full-scale invasion of Ukraine. He commends the efforts of both parties and the third-party facilitation by the United Arab Emirates that contributed to this positive development. The Secretary General hopes that this important step will be followed by additional exchanges of prisoners of war and by other de-escalation efforts. So on this, let me now turn to our guest. So as I said earlier, we have with us, we're pleased to have Mr. Hantanu Mukherjee, the Director of the Economic Analysis and Policy Division at DESA, as well as Hamid Rashid, Chief of the Global Economic Monitoring Branch, and they will present to you the World Economic Situation and Prospects Report 2024. So you have the floor.
Thank you, Stephanie, and Happy New Year, everybody. I'd like to focus my remarks around three sets of findings from the report: economic performance and prospects, headwinds, and divergences. So first on the performance and prospects. So our report finds that global growth for 2023 will turn out to be at around 2.7%, which is up from 2.3% that we were expecting in May 2023. But our forecast for 2024 is lower, down to 2.4%. In a nutshell, the world is struggling to get back to the 3.0% annual average from 2000 to 2019, representing years of subpar growth. Also, the better-than-expected performance for 2023 is chiefly driven by several large economies, notably the United States, but also Brazil, India, and Mexico. Overall, developing economies' growth remains pretty static at about 4% over 2022 to 25, a little higher for LDCs, but still well below the SDG target of at least 7%. Now, across the world, inflation is expected to be at an average of 3.9% in 2024, a decline of about a third from last year. And that's a rapid change. Back in 2022, we were seeing 8.1%. But, and there's a caveat, in about a quarter of all developing countries, the annual inflation forecast for 2024 is over 10%. That'll be eroding away what people's earnings can buy and inflicting further pain, especially on the middle class and people in poverty. And hunger will continue to be a special concern because local food price inflation remains high in many developing countries. And this is a situation which could easily be aggravated by shocks to domestic food production or even to the global food supply. Next, on to the headwinds. Now, while recent global trends in growth and inflation appear to be positive, there are significant differences across countries and considerable downside risks. These together are weighing down on expectations for this year, as well as on the prospects for achieving the SDGs by 2030. The report identifies these challenges as arising from monetary tightening, weak global trade and investment, and rising debt vulnerabilities, compounded by heightened geopolitical risks and the rapidly worsening impacts of climate change. The reversal of years of accommodative monetary policy in many developed countries, which we see because of high policy rates and quantitative tightening, which are both expected to be in place for some longer time, are also spilling over onto the rest of the world. They increase the risk of balance of payment pressures and debt distress in many developing countries. Finally, on divergences. Now, taken together, we are seeing some worrying divergences that undermine SDG prospects emerge between developed and developing countries. First, while all countries were adversely impacted by successive crises since 2019, uneven recoveries have set developing countries back much more than developed countries. Our estimates show that cumulative output losses up until 2023, relative to the pre-pandemic prospects, were about 10% of 2019 GDP for developed economies. That means, taken together, they're about 10% lower than they would have been without the shocks. And that's for the developed countries. But such losses were about 40% for SIDS and about 30% for LDCs. That's orders higher. And these losses, why do they matter? They are missed opportunities for income, jobs, public expenditure, in short, for many SDGs. A second point of divergence is around fiscal space. That's the amount of money governments have to spend from their own revenues, over which they have some discretion. So fiscal space remains limited across most countries, but can be especially constraining for developing countries. More than 50 developing economies spent more than 10% of their revenues on interest, and 25 spent as much as 20%. That restricted their capacity to respond to shocks or to provide essential services like education and healthcare. A final point of divergence is around the application of industrial policies. These are increasingly in vogue. They are lending greater direction and speed towards technological transformation and the green transition. The number of such policies at the global level grew by over 40 times in the last decade. But the capacity to undertake such policies varies a lot across countries, not just in terms of money, but also in terms of infrastructure, institutional readiness, and the quality of R&D institutions and human capital. In fact, while global spending on R&D is at a record high, there are just 10 countries that account for over 80% of the expenditure. Now, such policies are crucial for achieving the climate goals, but they also threaten to entrench a long-lasting wedge between the sustainable development prospects of developed and those of developing countries. Finally, our report offers options to address these many challenges, both at the national level and through international collaboration. Not all of them are easy, but they're imperative for advancing sustainable development. They range from avoiding self-defeating fiscal consolidation to advancing the Secretary General's fiscal stimulus, bridging divides in science, technology, and innovation, and enhancing effective collective climate action. My colleague Hamid will be presenting a more in-depth look at the report and presenting in greater detail some of the policy measures we're advocating. Thank you.
Good afternoon, colleagues, and Happy New Year. As you can see, that we don't have a lot of good news to share with you at this stage. First good news I would say is that at least the world economy performed better than expected in 2023. And that was driven by a surprise performance by the US economy. To a lesser extent, also the economy of Japan did very well. And some of the larger developing countries also did perform quite beyond expectations. On the other hand, European Union, we saw growth actually plummeted in the European Union, and that has been a serious challenge for Europe. And also some other developing countries, we didn't see the growth picking up the way we expected in 2023. But if you look at 2024, actually outlook is, except for two regions in the world, that is namely Africa and West Asia, we would see growth to deteriorate in all other regions. And this is also relative to the growth performance that we had between 2000 and 2019. Only region that would have a slightly higher growth rate relative to the previous 2 decades is Latin America. Latin America didn't have high growth performance. The dots on the figure represent the average growth rate for 2011 to 2019. So we see that Africa's growth rate would be slightly improving in 2024, mostly driven by performance in East Africa and also Southern Africa. And West Asia also we expect some improvement, but overall, for the rest of the regions, especially Latin America and the Caribbean, East Asia would see moderation of growth. And that is quite challenging, and we sort of present some of the key drivers of those growth depressors. We see the 5 factors coming into play. Most obvious one is monetary tightening that we saw starting from 2022, going all the way to middle of 2023. Very rapid interest rate increases really depressed borrowing and investments. Second, alongside the monetary tightening, we also see limited fiscal space across countries. Governments were not able to expand spending in 2023 to support and stimulate growth in 2024. Then we also see one of the shocking trend that we observed in 2023 is that state of global trade. Global trade actually, it didn't contract, but it hardly saw any growth in 2023, 0.6%. And if you look at the previous period before the pandemic crisis, global trade was growing at a very much faster rate. And this is concerning because without global trade picking up, which has been an engine of growth for many developing countries, will not see the return of growth that we had before the pandemic. Then, of course, geopolitical crisis, both in Europe and also in the Middle East, that is weighing in. And finally, climate risk and growing climate challenges also would have significant effect on growth prospects in the near term. And so, bit of good news in 2023 was, of course, the central banks managed to bring down inflation across in most countries, but still there are a number of countries that have high inflation, including countries where inflation is not double-digit but triple-digit, countries like Argentina, also Venezuela, and some other. So that would remain a challenge for some of the countries. But also we see where the inflation fell, but many central banks are not still in a position to reverse their monetary tightening position that they took in 2023, which means that tightening may continue for the foreseeable future. We are seeing a higher for longer kind of a trend in the monetary space. On the labor market side, we see quite a bit of divergence. The developed countries saw a very quick return to the pre-pandemic level of unemployment. In fact, some of the countries in Europe and also in the US, unemployment rates are at record low. We have also seen the wages growing very fast and to some extent giving some comfort to the higher price levels that households faced. But the story for the developing countries is very different, where you still have, in many countries, unemployment rate is higher than they were before the pandemic. And also, number of hours worked is not back to where it used to be. Gender gaps persist in employment. Gap has narrowed quite a bit in developed economies, but not so much in the developing countries. Because of pandemic-related response in the developed countries, we're very much sensitive about childcare and other benefits that were made available, and that really improved labor force participation rates for women. But we don't see the similar trend in the developing countries. So the risk for the global economy is obviously on the monetary side, and that risk is quite significant. We discussed quite a bit of that risk in our chapter 2 of the report, so we encourage you to take a look. We believe that there has to be some adjustments on the monetary side because at a very high rate of borrowing, especially the developing countries would face significant constraints to access the international capital market and to sustain the level of investment they need to promote growth and also to meet the SDGs. So I think that would be a significant challenge for many developing countries. In addition to that, there will be also significant balance of payment pressures for many of the countries because higher interest rate means higher debt servicing cost, and many of them, Hantanu mentioned that debt servicing cost as a percentage of their revenue is very high for a number of countries, and that is leading to debt overhang, meaning that new investments are not coming into promoting growth and supporting the SDGs. So debt vulnerabilities, as a result of that, we see more debt vulnerabilities for many countries. In the past year and a half, we saw many countries are in debt distress, and few countries have defaulted, including 3 countries in Africa are in default right now: Zambia, Ghana, and most recently, Ethiopia also defaulted, had a technical default. So the couple of challenges that we see is that, of course, on the trade side, and we see that trade has been faced a significant challenge, and that's actually started before the pandemic, but we see the continued challenge in global trade, more fragmentation, external demand for developing countries has been weak, although we saw quite a rebound in the U.S. economy, but U.S. imports from the rest of the world didn't pick up as much. Also, strong dollars have not helped many developing countries to increase their imports because that has been a drag for many developing countries. And geopolitical tensions also played a very important role in suppressing or depressing trade growth. And alongside, investment also has remained subdued in many parts of the world. And we know that investment is the major driver of global economic growth, especially in the domestic front. And as the liquidity situation remains very constrained for many countries, we don't expect investment to pick up significantly in the near term, in the forecast horizon in 2024 and 2025. So this is, again, to re-emphasize the point of the debt risks for the developing countries. We are observing very closely the debt situation in many of the LDCs and low-income countries, where we see that many of them, even if they have not defaulted, they face significant risks in terms of servicing their external debt obligation. And that also restricts their fiscal space in terms of carrying out the expenditure they need to support employment and economic growth. And also these countries are very vulnerable to another round of shocks. If there's another shock from the global economy or from the regional sources, these countries would face significant challenge to withstand those shocks. So in terms of the policy space or policy levers available for the developing countries, we should identify 4 related areas of policy intervention. Monetary policy side, I've already mentioned, very limited right now. Some developing countries have already started easing, which is good news. China, for example, was able to reduce the policy rates twice this year, and also reduce the reserve requirements to provide more liquidity to the market, which has been a good news in case of China. Other developing countries are also going in that direction. They're not waiting for the Fed to take the lead. But overall, the monetary stance for many smaller developing countries would remain very tight, and that would be a challenge. And so they have to find policy levers elsewhere. So on the monetary side, there might not be much support to provide. Fiscal policy is also quite constrained, fiscal space, in most developing countries because of the high level of debt accumulated during the pandemic. And also before the pandemic, many of the countries were already heavily indebted. But our strong message for the readers is that the countries must avoid fiscal austerity at this stage, because if fiscal austerity would be self-defeating, it would just drag growth further down. Also, it's very limited for them to increase taxes at this stage. So the option would be to have more fiscal efficiency. So improving fiscal efficiency is very critical at this stage. Hantanu talked about industrial policy. Many countries are seeing more opportunities on the industrial policy side, more targeted intervention, more bang for the buck kind of approach, because industrial policy can give a lot of mileage for countries in terms of supporting transformation of the economies and creating more jobs, green transition that require industrial policies. But the challenge for many developing countries is that it requires a lot of R&D, a lot of technological know-how that's not available in many countries, but that has to be, that gap has to be bridged in many countries to have successful industrial policy interventions. Finally, I think much of the global if we want to get the global economy out of this lull, we need stronger international cooperation. And it's an imperative at this stage, because without international cooperation, we can't really revive global trade. Global trade has been slumping for some time now. So we would need strong international commitment to revive global trade flows, and making the WTO and other trade mechanisms, rule-based trading system has to be fully equipped and fully empowered to support global trade flows and and revive trade's role as a driver of economic growth. And also, we are at a critical stage in terms of our goal for achieving the SDGs, and SDG financing has to be scaled up, not just in the domestic level, but also internationally. There has to be far more resources made available to address climate risks, climate adaptation, and climate mitigation. We take note of some developments in COP28 as positive developments, but more needs to be done in terms of support for the countries, especially countries that are most vulnerable, especially the LDCs and the seeds that face significant challenges coming from the climate side. And we would need to have more international support and cooperation in that front. And finally, there needs to be far more international commitment to debt sustainability. That would begin with some debt restructuring for some of the countries. Countries that defaulted on international debt commitments have not been able to get a full debt settlement restructuring as yet. Still, countries are in negotiations with the creditors, but there needs to be far more accelerated progress on that front to get especially the developing countries out of the lull and put them back on the trajectory of growth. I'll stop here. Thank you.
Thank you so much for this very good presentation. Let us now turn to questions from the room. I see Edie. Please go ahead.
Thank you very much on behalf of the United Nations Correspondents Association for doing this briefing. Excuse me. My name is Edith Lederer from the Associated Press. At the beginning of 2023, there was a lot of talk of possible recession. Neither of you mentioned this, and I wondered if you could tell us why this never happened, and is there any expectation of a recession anywhere in 2024? Thank you.
Okay, let me start that, and Hamid, feel free to chip in. Yes, you're right. There was talk of recession in 2023, mainly driven by the fear that inflationary expectations would be hard to manage. And so interest rate hikes would be actually turn out to be a huge damper on the economy. But as it turns out, that hasn't happened, particularly in the US. In the EU, as Hamid mentioned, growth has actually shrunk a lot. So in the US, as the world's largest economy, because this didn't happen, and people say that a soft landing was actually achieved in terms of being able to curb inflation without actually putting brakes on the economy. So this is really the main factor as to why we didn't actually head into recessionary territory, even though at the beginning of 21, given the high rate of inflation that was persisting at that time. I already mentioned it was 8.1% in 2022, 5.7% in 2023. So there was indeed a real fear that interest rates would have to rise so much to bring inflation down to the 2% target rate that it could trigger a recession. But as it happened, supply chains got smoothed out faster. So actually, inflation fell fairly rapidly once it started declining. And we are still not out of the danger zone, I would think. But Hamid, over to you.
Yeah. No, I think two additional points that I can share is that U.S. economy definitely surprised the analyst about avoiding a recession. And that's partly explained by what happened on the U.S. household balance sheet. The American households kept spending and spending, partly because net worth of the American households actually improved significantly since the pandemic, which is very counterintuitive, but that's exactly what we see in the data. Households felt richer despite very high levels of inflation. Spending continued, and that supported economic growth because household spending is a major driver of economic growth because it accounts for about 70% of the U.S. economy, household spending. So contrary to the expectation that we had that higher interest rates would depress household spending, we didn't see that materializing in 2023. Second, also another probably a corollary to that is that economists don't agree on exact when the effects take place, but there's a varying lag effect of higher interest rates. in the U.S. economy in the past, we saw between 18 to 20 months for the higher interest rates to take effect. And that's why we're less optimistic of the U.S. economy in 2024. We'd see some moderation in spending. Still, household spending remained very strong in the fourth quarter of 2023. And we expect that spending would slow down quite considerably. I would not say significantly in the first H1 of 2024, and that's what would drive down U.S. growth rate to what we say about 1.4% in 2024. But to your question, that we don't see a recession, which is a technical term, about 2 consecutive quarters of negative growth, we don't see that happening, at least in our forecasting horizon for the U.S. economy and for the global economy.
Can I just follow up? You said that we are still not out of the danger zone. Could you elaborate on why?
We are not out of the danger zone in terms of the general environment being fairly unsettled. And should there be an increase in inflationary pressures, let us say due to supply chain shocks, or changes or disturbances in how fuel is made available, then those inflationary pressures could prompt a further interest rate hike in order to bring it under control. And that is the kind of thing we have at the back of our minds when we say that going forward, although as Hamid said, we are not expecting a recession per se, but because there is volatility in the environment around us, this is a major source of risk. Another is that actually sustained high interest rates for a very long period is something the world has not seen for a long time. And this imposes pressures on all parts of the financial system. We hear of it in the context of developing countries that have taken loans and are finding it hard to pay back because interest rates have gone up. But similar is the case with banks and other financial institutions that may have unbalanced portfolios of loans they have made out. And I think you saw this earlier in the year in February, was it? In February, March, when there was some kind of feeling that the financial system had come under stress. And so it is a little bit uncharted territory here as we are going forward with very high interest rates sustained over a long period, with the threat of possible shocks to prices, with the certainty, I think, that quantitative tightening, which is undoing a lot of the quantitative easing that was done earlier, is here to stay. All of this makes for quite a difficult balancing act. So that's really why we said that we are not yet out of the woods.
James Bays from Al Jazeera. You're giving us a very big global perspective. I would like to raise something quite specific, something that's been raised in this room and raised in the Security Council in the last 24 hours, which is the tension in the Red Sea, with the Houthis firing on shipping, with the build-up of Western militaries. Could you put that in context, in perspective for us? How worried should we be about the economic effects of that?
Thank you. I think these are events that we have a cut-off date when we finished our report. That events were not happening at that time, but if you ask me what would happen, of course it will have some impact, but we can't yet quantify exactly how that would affect the growth prospects. That's why we see geopolitical risk as a whole a risk to global growth, not only for the region, but also for the entire world. Because as, for example, if this continues, then there might be a shock to the oil supply, and oil prices can go back up very quickly, and that would bring back inflation, as Hantanu was talking about. Then central banks, instead of easing or cutting rates, they may be forced to raise rates again. That would bring us, so it can be a cascading effect, and we would probably see a probably even a worse outcome for 2024 than what we are predicting right now. But to answer your question about the Red Sea events, obviously that's not captured in the report because the report was actually had a cutoff date. But we are monitoring it on a daily basis about all the impacts. And also, I would like to highlight one point here that even in good times, it's very difficult to have a quantifiable assessment of any kind of political risk. And in good times is difficult, but in difficult times when there's already countries in conflict, to have an estimate for the GDP impact, how much GDP would be lost, is extremely difficult, especially in countries where the data is sparse and the quality of data is not always up to the mark. So we usually don't predict a particular GDP outcome for a country that is in conflict, because that way it would be just speculative in that sense. Thank you.
Vladimir National News Agency of Ukraine, Ukrinform. I've got a similar question, perhaps. How does Russia's war against Ukraine affect economic trends in the world?
Go? Yeah.
Okay, I can start.
Yeah, sure.
Yeah. Hamid, I think kind of was referring to this a little bit when as economists, it's very hard to have cause and effect very clearly laid out. Russia's war in Ukraine started back in February last year. And since that time, many other things have also happened. And so it becomes difficult to pinpoint that it was A which caused B. Certainly in the immediate aftermath of the commencement of the war, a lot of oil prices, etc., rose appreciably. But they have now come down. So to make a composite assessment of how much the war in Ukraine is affecting the global economy is difficult because there are many other factors affecting it. What we did see last year was that the Ukrainian economy shrank by about a third. And so there is a modest improvement this year, but it's like in an improvement on paper, because if the economy is already shrunk by a third, then a small improvement is not going to restore it back to where it was before the conflict started.
I think to answer your question, we already see some impacts, especially in Europe. If you look at the largest economy in Europe, Germany actually contracted in 2023. That's the only large economy that had actually a technical recession in last year. And even the growth prospects for Germany this year is quite, I would say, quite somber, because European Union as a whole is expected to grow by only about 0.6%. Let me just, to be absolutely sure of the number, we expect the European Union to grow by 1.1% in 2024. 1.2%. So that's a very, very modest growth rate for the region, even to catch up some of the lost output. So we are seeing direct impact from the war, and of course we can have a direct causal relationship, but that multiple channels affected the growth prospect, including in some cases we anticipated that high energy prices would affect the growth, but energy prices didn't stay high. But there are other channels that affected growth, including resources that are committed to war efforts and to supporting Ukraine. So I think there's quite a bit of challenge in Europe we see going forward because of the war.
Mr. Rashid, this question is for you. Last year you were here talking about some of the problems the Chinese economy was facing, namely the property issues, the domestic consumption. Last mid-year review of the report, you said the forecast of Chinese economy growth in 2024 was 4.5%, and this time you set the number to 4.7. What makes you change the number up 0.2%?
Because we are more optimistic about China's growth outlook in the near term, because the outlook is stable. We see quite a bit of space both on the fiscal side and also on the monetary side. Fiscal side, government of the People's Republic of China announced this $1 trillion or issued the $1 trillion bond, domestic bond. Half of it was spent or disbursed in 2023. Other half would be in 2024. So that definitely provided a lot of support. Would provide. When we were doing the mid-year update, there's no $1 trillion yuan sovereign bond issue so on the horizon. But now you have a $1 trillion sovereign bond injection of liquidity, and that would trigger some growth or change the growth upward. So that's, simply that explains 0.2% growth improvement. But also on the monetary side, we see quite a bit of support two interest rate cuts by the People's Bank of China, and also lowering the reserve requirements. That helped quite a bit. And also you see in terms of overall household spending remained robust. So we see stable, and it may even improve further. We expect a further improvement as we move forward. But we are not terribly concerned that this housing challenges that we saw earlier in the year, that has been contained to a large extent. We didn't see any deterioration of what we saw in mid-year. So from that point of view, we have reasons to be optimistic that in a 4.7% growth rate is our baseline scenario for China. But by mid-year, we may have to revise it to some extent. Yeah.
Please go ahead.
What are the drivers behind the significant growth by India? And also, what do you think are the risks to it in terms of not being able to increase its, or what are the factors that are blocking it from increasing its growth? And also, you mentioned something about the risk from El Nino.
Yeah.
Thank you.
Yeah.
Okay, I can talk about the risk.
Yeah. So no, I think Indian economy again outperformed its peers, not just this year, but the previous few years. And you see that growth has consistently remained over 6%, and we believe this will continue in 2024 and 2025 as well. Several factors. India, unlike many other countries like Brazil and others, India, although inflation was relatively high, didn't have to raise rates as much. And inflation has come down quite a bit since our last report. And that has allowed government to sustain the fiscal support that it needed. We didn't see significant fiscal adjustments or fiscal sort of retrenchment in India. In fact, fiscal support is still pretty strong, I would say. And overall, I think domestic consumption is growing. Household spending, the ability for household to spend has grown. Employment situation has improved quite a bit. So we are very optimistic about actually India's growth outlook in the near term. So, and this is again a region in the world right now where it is becoming a major source of growth. What we saw in the past, East Asia was the major driver of growth, but now we see that a little bit of shift towards South Asia being the driver of economic growth going forward.
Thank you. Yes, Alan.
I just wanted to add.
Yeah, oh, yes, please, go ahead.
Right. You were asking about risks, and I'm not sure that 7.7%, 6.3%, 6.2%, and 6.6% is exactly holding something back. So in fact, I think one would, in a kind of abstract sense, one would run the risk of overheating an economy if you grew at much faster rates of the size and complexity of India. But I think among the factors Hamid was mentioning, the government has also recently modified its tax collection systems, and those have also certainly helped and given a more sort of stable playing field for businesses and other initiatives to progress. Some of the risks are actually more global in nature, and India still remains a very largely farm-based economy in many senses, and being in the tropics, it is very vulnerable to climate change, and El Nino is a recurrent phenomenon, but exacerbated by climate change. And so should there be a shock to agricultural production, this could cause a major disruption in the economy. We don't anticipate such a shock, but should there be one, this could be problematic. One of the reasons that the consumer price index in India remained relatively within bounds, allowing this the central bank to not raise interest rates too much, was that food prices and fuel prices remained relatively stable. So any shock on those lines would boomerang through the economy.
Thank you. Alan, and I think after Alan, we will wrap up if there are no more questions.
Thanks so much for doing a briefing. Alan Bulkati from RIA Novosti News Agency. Could you please describe the trajectory of Russian economy growth last year, and what are your projections for the 2024?
CIS. We estimated, again, this is an estimate, that our, in 2023, Russian economy grew by about 2.7%, which is, again, this is our estimate from our work. And we expect this growth to moderate to 1.3% in 2024, partly because inflationary pressure is high. Central bank raised rates quite significantly, and all the benefits of that earlier sort of adjustments policy stimulus that was given by the government, I think they're dissipating to some extent, so growth would moderate. But also from the reports that have been released recently by the Russian authorities, we see that actually there was no contraction of the economy in 2022, which surprised many analysts. Instead of a contraction, actually, Russian economy grew by roughly, according to that estimate, I think it grew, had a positive growth of over almost 2%, 1.2% in 2022. Yeah, no? Yeah. Negative 1.2%. Yeah, it contracted by negative 1.2%. Yeah, yeah. Russia, yeah. 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 So instead of 2.1% that we estimated, the contraction was actually smaller than we expected, or 1.2% contraction.
I mean, one unfortunate fact of GDP is that if you spend on military, it does show up as an increase in GDP. And that's going on there as well.
Excellent. If there are no more questions, thank you so much to both of you for coming, for your patience. And while we were doing the briefing a little late, thank you so much. Thank you, everyone.